Hello, everyone. I am incredibly excited to be here for day 5. And been a part of a lot of amazing events as well. Um, I am joined by three wonderful people here. I'll let them introduce themselves, but in general, their names are Richard Dulude, Daniel Acheampong, and Betty Francisco. So, Richard, would you start with an introduction, a little bit about yourself?
Sure, happy to. Good morning, everybody. I'm Richard Dulude, one of the co-founders and partners of Underscore VC. Many years ago, was actually an entrepreneur, had started and sold a company, and then was thinking about starting another one, and ultimately was incubating at a venture firm, and instead found it pretty fun to look at a lot of opportunities, and so ultimately started Underscore about 7 years ago. We raised a 85 million first fund and 140 million second fund, which we're actively investing out of now. So that's me.
Brilliant. Thank you
Betty, you
so
want to
much.
go?
Good morning, everyone. Can you hear me? Yes. I'm Betty
Yes.
Francisco. I'm currently CEO of Boston Impact Initiative Fund. We're actually a nonprofit impact investment fund focused on investing in entrepreneurs of color in Massachusetts. We're about to launch a $20 million fund next week, and it's to continue investing in entrepreneurs of color and in community owned and controlled real estate. I started at Boston Impact last year. I got to know the organization prior to that, being on the investment committee. And before that, my career has been actually as a corporate lawyer, mostly focused on representing investors, tech companies, life sciences companies, and doing a lot of venture capital deals as well as mergers and acquisitions. So that's how I started to understand investing, but never actually got the opportunity to do it. And then in 2015 or so, I started angel investing through a program called Pipeline Angels, focused on getting more women to invest in social ventures led by women. So it's been a journey for me, both as an individual investor and now as a fund manager. Glad to be here.
Awesome. Well,
Thank
it's good to see you all. I'm Daniel Acheampong. I'm general partner and co-founder of Visible Hands. We are an early stage pre-seed fund with an accelerator that's connected to it. And our model is that we want to identify really talented women and folks of color who are building venture-backable technology companies. And before Visible Hands, I worked at a private equity firm for several years, and then before that, I was in asset management. So for me, this is an exciting platform, and I began angel investing for about 3 years before even starting Visible Hands with my partners. So looking forward to the conversation.
Fantastic. All right. Hi, everyone. My name is Vic. I'll be your moderator here. My background is kind of varied. I started working for the government 2 years in NASA, and then I went into deep tech for research. And then somewhere down the line, I started connecting angel investors to VC firms and also to universities in countries in South. And ever since then, I myself went into angel investing and understanding opportunities, and also helping accelerators find startups as well. So thank you all for joining us. In the audience, we will have a lot of people who are coming from different backgrounds to investing entirely, or that could be just a switch from one career to having decided, hey, I'm going to invest in a different part of my career for an opportunity for startups and whatnot. So just make sure that if you have a question, ask it. All questions are wonderful and valid. So the last person to speak was Daniel, so I'll actually kind of pick on you a little bit. You, as you mentioned, Invisible Hands recently launched their first round, their first fund. So when raising a fund, how do you determine how much to target?
Yeah. So before you take on the responsibility to raise a fund, because there's a lot of work. As fund managers here know, going to ask people for money, there's a lot that comes with that. You have a responsibility that you're really you have to take seriously. So in doing that, identify what do you want to invest in. So have a thesis.
Yeah.
And then ensure that you have done the work, your personal diligence. Say, like, are you the right person to go out and execute this thesis? And then if you believe you're the right person, what are the other resources you need to get it done? So for me, in going out to build out Visible Hands, with my background from asset management and also from the private equity world, I knew that there were certain keys that I needed to support me in doing this. So one of my partners, Justin Kang, he came from the world of actually helping build out companies and building out accelerators. So that was a key component that we needed. My other partner, Yasmin, she's phenomenal at fundraising and building relationships. So from us, from that perspective of doing that on the LP side, but also on the portfolio company side, how do we support our companies in helping them build, grow, and scale that? And then the personal thesis that we identified that was so for us really important was, if you look at the venture continuum, something we keep hearing is that there's a pipeline issue to invest in diverse founders. But we thought that was actually a false narrative, because women and racial minorities make up about 70% of the U.S. population, but they receive less than 10% of invested dollars, right? So we said this is actually a missed opportunity across the landscape. So what if we were to come in and create a platform that identify this incredible talent, and not just give them money, but also put together wraparound resources and help them build at the early stage to move on to the other stages of company building. So we build out Visible Hands as a way that we're creating this connected capital, right, with the Underscores of the world, with the Mendoza Ventures of the world, so that we're helping really talented folks build out their companies, grow to the next stages, and hopefully that they can create valuable companies and impactful companies.
Brilliant, brilliant. Now, I have to touch upon this a little bit, just because when you mention building out that thesis, I want to remind people that that thesis is the core, it's the crux of into investing at all in the first place. Know thyself, essentially. Many people come from recognizing, hey, this is going to be my first venture into investing, so let me do it in a field that I'm comfortable with. Wherever you made your money, maybe this is where you start to invest. But also, I want to remind the audience, people should remember there are other ways of trusting where that investment should be. Are you trusting in the founder, him or herself? Are you entrusting in the field, in the economy? Where are you finding your trust? And so I really appreciate you, Daniel, making sure that, hey, it's part of the investment thesis. On that note, Betty, you mentioned that your firm is also a nonprofit. Can you touch a little bit upon some of the differences with you?
Sure. So we also have an investment fund, but we're a debt fund. So we raised our money through debt capital, and it's mostly from accredited investors, wealthy individuals, DAFs, some philanthropy as well. We have a very diverse capital stack. And one of the things that was important for us was to also provide an opportunity for community non-accredited investors to invest in our fund. So we have a small layer of our fund that is designated for non-accrediteds. In our new fund that's about to launch, it's a $20 million fund. $1 million of it, that sleeve, is designated for non-accrediteds. And part of the goal is to get more women, people of color, to become investors in this fund. And it's debt. So this is, in market terms here, it's called a concessionary fund, because it's not going to generate the kinds of returns that a venture capital fund would, but it's going to generate both some financial return and impact, hopefully exponential impact in terms of addressing the racial wealth divide. So our particular fund thesis is focused on investing in entrepreneurs of color that are small to medium size. Some are startups, but they don't have access to the kind of capital that they need to start up and grow. But they're not necessarily highly scalable ventures the way you might be investing in, and also yourself, right? Because there are a ton of companies that could get to, mid-market capitalization, but they don't have the same access to the kind of capital and don't need necessarily venture capital, right? So we have this dichotomy of just loans, debt over here, and venture capital over here. And people don't really talk about the in between. And often entrepreneurs don't even know what exists in between, right? So the unique thing about the Boston Impact Fund is that it provides integrated capital to entrepreneurs. So we invest, although we're a debt fund, we invest in everything from debt, equity, near equity. We do every kind of transaction, right? From convertibles on the equity side to preferred stock, and also on the debt side, because some companies need debt capital as well. And the goal of this second fund, because this is fund number 2, is we saw an opportunity in the market. There's a lot of debt capital right now. Like every CDFI, again, in the nonprofit sector, there's a lot of money that came from the federal government due to COVID. And so loans are plentiful. But what's not plentiful, especially for entrepreneurs of color that need follow-on capital, because now they've gotten their ventures to scale up a bit. They're employer firms, but they need equity capital, and it's patient long-term equity that's non-extractive. And what I mean by that is that we are willing to exit that investment early as an impact investor. We're only looking for a certain amount of return, 1.5 to 3x, because what we want is for that venture to be as highly impactful as possible, right? In terms of maintaining ownership for entrepreneurs of color, providing workers ownership opportunities, paying people livable wages, having an ecological impact in their communities. So we're looking for a different kind of return. And the more impactful you are, the less financial return we're willing to take. So it's a very different and unique model. I actually find it really fun because we can do every kind of investment and use every kind of investment vehicle. And then you talked about sort of the question was, how do you think of your thesis? When we were looking to launch the second fund, we didn't exactly replicate the first one, right? We identified the need for more equity. We also identified the need for focusing on entrepreneurs that are more in the climate resilience space. And then something to address what's happening sort of in our areas right now is the massive displacement happening in our communities, both for business owners, right, that are getting kicked out of their spaces, have to move further away. So we're also going to be investing in community-owned and controlled real estate to prevent displacement.
Brilliant. Thank you so much. You started off speaking a little bit about recognizing that not all investors need accreditation, and I really appreciate you mentioning that. Many people think automatically, hey, we must be accredited. So let's talk as a group. How do we address that? So I'll start with you, Richard. How important, we understand that it isn't absolute that we have to have it, but let's say how important would be gaining investor accreditation?
Yeah, absolutely, Vic. Well, I think it's an interesting question, and I'd actually back up to why does accreditation even exist in the first place? And the reason is actually about investing protections at the end of the day. And it's really been put in place as a means to basically prevent people from investing amounts of capital that they probably couldn't absorb at a means of the risk profile that these private investments really are. So it's defined right now, I believe, and you probably know as well. It's 200,000 or some threshold of assets as well. Yeah, something like that. Well, and so it's interesting of basically you're preventing a certain group of people who don't meet this relatively arbitrary threshold from investing in potentially some of the highest return areas that are out there. That said, I don't think people should be putting a large percentage of their net worth into illiquid private investments. I've been investing in this space for at least a decade now. I probably have 40-ish angel investments even before that are, let's call it 7 to 8 years old, and I have gotten liquidity out of maybe 2
Yeah.
of them. So it's basically capital you're not going to see for a long period of time. And so that's why a lot of these protections were originally put in place, because somebody who makes $100,000, should they be investing $10,000 into a private startup, 10% of their net worth for 10 years? I don't know. It's a question of who gets to determine that choice. I think any individual who earned the capital, probably, if they're thoughtful enough, should be able to determine where they want to put it themselves. So I generally actually am against accreditation rules. And I think there's means for people to find their way around them too. So,
it's funny you
anyways.
mentioned that, because that's often an issue when people decide to start a family firm in themselves. The determination of, well, how much and if we should be accredited. So appreciated that you mentioned that.
Yeah, can I
yeah.
double click on that? I think also those protections are important, but it could also be preventive for wealth creation, right? If you see a really amazing company, entrepreneur idea, and they're executing it well, and you want to put capital behind it, because of the accreditation rule, it could be really hard to do it. Sometimes you can't even do it. I know the SEC have made some adjustments to allow people to reduce the restrictions, but I think it could actually be preventive from wealth creation.
Yeah, and triple click on that. So that's why. So the SEC did pass some amendments to the regulations to allow people with some, sophistication and education now to invest, even if they don't meet those income and net worth thresholds, which is good. But think of it, you still have to have a certification of some kind, right? So it is. It does have this unintended impact of being exclusionary. And what I'm heartened by is that there are, now more investing options, more retail investment options for non-accredited investors, right? They keep proliferating, but they don't necessarily disclose all the risks, and you're not really sure how am I protected. So, when we did our fund, of that community note layer that I talked about, it's protected because there's a philanthropic layer at the bottom, and then there's a solidarity layer, and then the community note, meaning we have to fail really badly, right, before the community notes lose anything. So we know guaranteed we're going to pay those people back, because we'd have to lose $19 million, right, before we repay. So there are some protections that could be built into the fund structure to make sure non-accredited investors are protected, which is important to us because of who we want to build wealth for.
Yeah, and I would also underscore, while we're on this point of, I wouldn't be investing, amounts that are uncomfortable to lose. I always, this is the frame that I always take with it, which is, if I could truly be comfortable never seeing this again and just getting a zero on it, that's probably the right amount to invest. Anything that makes you more uncomfortable than that probably is too much.
Nice. And that's a beautiful segue into the next question. How exactly do people, or should people, determine how much to target? And you're saying, essentially, if this is never seen again, that's a comfortable amount to invest. Any follow-up for that? Let's say Betty? Oh, I'm sorry. Or Daniel?
Yeah,
I'll go after Betty.
I think it's all individual. I mean, personally, as an angel investor, I think of it like you just mentioned, Richard. Like, am I willing to lose this? Right? This is something I could have put in my 401k. I could have put it in a savings vehicle. I could have bought a house, another house. But I want to invest it in a company I believe in. And am I willing to lose it? That's how I think about it. I actually don't know what percentage it is of my savings net worth. I don't know, maybe 5%. Like, it's discretionary money. You have to think of it that way. And the upside could be great, but it's true. Like, I've out of my angel investments, one has repaid with a tiny bit of return. 2 have closed. They could close during COVID. So things can happen. You can lose your money, and it's very real. Like, they say that, right, to diversify you need a minimum of 10 angel investments, minimum, right? 8 probably will fail. And then the last 2, one might, pay you back what you put in. And one or 2, maybe, if you're really lucky, will return your goal return, which it's also personal. Like, what do you want out of it? Are you willing to just double your money? Do you want 5 times your money, 10 times your money? So we all have different theses around what we're interested in getting back from these investments. I also think, because of my early ones, I was interested in supporting an entrepreneur and seeing that journey through, because even though they may not have succeeded or sold the company and now it's different, during the time that they were in business, they provided a lot of impact as far as their product or service. So I often don't see these as complete failures, right? But but you do have to be willing to lose it all.
Yeah. Daniel, you had something to say?
No, I totally agree with what they both said.
Yeah, I will also follow saying that hey, it doesn't have to be the $20,000 buy-in. Maybe I'll invest just 5,000. Maybe I'll start off small and recognizing, hey, these are opportunities to just get your feet wet. But that actually brings us into one of my later questions as well. Given, the first 10 deals you guys made, what are some things that you wish that you knew back then? Especially the ones that did not work, in fact.
Yeah, so there are a couple of kind of personal principles that I have in my mind. Number one is that there's always another bus. So don't feel like you have to jump on this bus, right? So don't rush to get in a deal. It doesn't matter how attractive it looks. And this is connected to the next one is do your diligence, like DYD. You have to understand what the company's building, why they're building it. And actually, I emphasize why they're building it more than what they're building, because when they understand the why they're building, it means that they spent a lot of time on truly understanding the problem. When they go to the what, then it goes to a solution process. And I think when there's too much attention on the solution without the problem, then actually there's not enough room for iteration of the business, the idea, the team, and all of that. So the why is so critical. And then the last thing is you're investing in the team, right? If there's any concern about the team, don't go back to rule number one, don't jump on a bus. Right? So those are my personal principles that I keep in mind for angel investing. It is also connected to how I think about even now institutional investing.
Thank you. Thank you so much. I'll follow the same question for Richard.
Sure.
Some
So
of the bad deals. So what did you learn from?
Yeah, I'll build upon Daniel's, which is the bus. Every once in a while, a rock star bus comes along, and it's kind of the blue moon rock star bus. And sometimes I think you want to back up the truck and fill the bus as much as you can. So I suppose I've had, in some ways, a similar learning on that. But it really, the last point Daniel made as well is around the team. Everything else in these business changes, right? Product, market, company, n number of exogenous things can happen. And so the only thing that really matters is the team and how resilient they are. And I think if I look at the first 10 deals that I ended up doing, I think there were things that I didn't necessarily see or assess in the team. And there's, I would call it, there's no cut type of an entrepreneur, which is the interesting part. Let's say there's 10 attributes of what makes a great entrepreneur. I've never seen anybody who has all 10. They have various combinations of 4 or 5 or 6 of those things. And so, across a longer span of time, you start to pattern recognize and kind of pick those out. But what I also found is that across those opportunities, the value of which I put the weight of diligence on references. I mean, being able to understand somebody who's worked with this person and knows what they're like in the trenches is just so invaluable when it comes to assessing something. And a lot of those things pan out. I mean, it's just really funny to go look at reference notes and then 5 years later into a company of the little kind of anecdote that somebody said actually generally, pans out positively or negatively.
Nice. Betty, would you give us some of your advice as well?
Sure. I think for me, it's also understanding is this company in a sector and industry where I even understand it, right? Because
Yeah.
when you do the bus analogy, there's lots of different types of buses, and there's some that you probably have no interest in riding, and some that you do. And I think for me, it's like, can I add any value to this company beyond my check? Because the check is actually very minimal compared to what I think I can do to maybe open a door to a customer relationship, a partnership. Can I be a good mentor to this company and the founder or founders? That's partly what guides me. Like, can I add extra value? Because in the end, money just gets you so far in a company, right? You need what we call as part of our integrated capital approach, knowledge, social, and political capital, right? Who do you know that's going to help you continue to scale up and grow and tap into the relationships that you need for that? And so when I look at investing, is, can I do that? Like, do I have any relationships that could help this entrepreneur? And then on the sort of, looking back on founders in particular, I think something that I really value personally is humility, right? Being able to listen to feedback and be flexible and pivot, because you will need to do that eventually. I mean, look at what happened during COVID, right? Everybody had to pivot in some way. And so the more stuck you are with, this is my way, this is my solution, and you start to see that and recognize that, it makes it harder, right? I think to work with a person in the long term.
It does. And actually earlier, Betty, you had mentioned that, founders are often dealing with roadblocks such as, well, perhaps they are being priced out real estate and whatnot. So could you talk a little bit more about how, especially since you said, how do I ensure that my check and I as a person invest in the company more than just the money? Can you speak a little bit more about other ways such as real estate and everything? Yeah.
Yeah, I mean, with some of the most recent investments we've made, some of them have been so early that they don't have their space yet, right? So we're connecting them to a broker, to a real estate agent, helping them review the lease, or connecting them to a lawyer that can review the lease. I mean, that's, for me as a lawyer, right? That's the first thing. Make sure you don't sign a lease that doesn't give you the right to do X, Y, Z. And a lot of entrepreneurs that never had to review a contract of that nature won't even know that they should get a lawyer to help them. So part of the real estate piece, if you are going to be a brick and mortar, is that space is so important, right? Are you going to be stable in it? And if not, can you even get out of that lease without a lot of financial impact? And then also, we've heard from a lot of entrepreneurs nowadays, they want to own their property. They actually want to purchase. And so beyond what our capital can do, a lot of the work that we're doing is advocacy to our legislators, to the state, to provide funding for businesses to acquire their property. So how there's like first time home buyer programs, like so that you could buy your first home. There's nothing on the business side for new businesses to buy their properties. Well, why not?
Yeah.
Could we create that? So advocacy plays a big role also in looking for funding to support businesses in a different way.
Yeah, can I add to that, Vic?
Absolutely.
Yeah. So the money piece, to Betty's point, is important, but the most important thing you're bringing to the table is your time, all right, and the value that's associated with that time. So before you even write that check, I think it's important to have the conversation with the entrepreneur that, like, how can I truly add value to you, to your team, to your business? Because the money, the probability is that you are probably going to lose the money, but what you don't want to lose your time. All right, that time investment is critical.
Yeah, brilliant. I have to follow up on that as well, just because personally, I understood that when I was advising some of these companies in Florida, as well as some companies down in Eastern Africa, I recognized when I put in the time to actually go over their P&Ls, when I put in the time to actually recognize the back of the house kind of, hey, are you aware that there is, your government's equivalent of an SBIR grant? Have you looked into it? That was where a lot of the value was gotten. Richard, can you tell us one or two anecdotes of where you recognized, hey, beyond money, this is where I'm going to shine for you?
Sure. Yeah. I mean, I do think it comes down to time and how you apply it. And so to me, one of the biggest levers that you can have in impacting any of these companies is actually the helping find the perfect talent to join them. Often, I call it, there's a stand up team, meaning they have, everybody in place, or there's a standout, meaning they have something really kind of spiky and exceptional, yet they haven't really rounded out the team. And so very often in the ones that are kind of spiky and they're really strong in one dimension, but are kind of lacking, whether it's a CFO or some kind of financial expertise. What we can do is often find and help introduce some of those types of people. So I think talent is probably one of the biggest levers. I think customers at the end of the day are one of the other big levers. I mean, if you can take a company from 0 customers to 1 customer, that's a pretty big needle mover. If you can take them from 1 to 10, yeah, it's huge. It's from no business to maybe a business. Yeah. And so I think talent, customers, potentially strategic partners as well, depending on the area. We're connected to a lot of people, and so we can often kind of work the network to find somebody who can help accelerate the business in one dimension or another. So those are kind of the main vectors anyway.
Brilliant. And you know what, since you're on the line, I'll also ask you, when it comes to things like general partners and fund managers, what are some key traits that you look for?
Yeah, so I'm not only an investor, but I'm also an LP in a bunch of venture funds. So I actually get to look at the other side of the coin here. I think it comes down to why are they really doing this at the end of the day, and what's their objective, right? So Betty and Daniel have kind of their own set strategy and objective, and it's so clear what they want to do. And to me, that's kind of one of the first litmus tests of do they know why they're doing this? Then ultimately, depending on the lens you're taking, if it is really investing in a venture capital fund or any other type of private equity fund, it's are they thinking about where their edge in the market is? It's a very, very competitive business, and all cash is green, and entrepreneurs get to choose where they go. And so really thinking about, do they have a sharp edge of their spear to go out there in the world and be successful? And so those are kind of the main ways, at least I think about it. And then ultimately, if they have been in business long enough, are their returns good? Track records can be helpful. And I come back to what I mentioned earlier about looking at early stage entrepreneurs. When looking at a venture manager, references are just so important. They tell you, everything about not only how are they going to work with entrepreneurs and the people they're working with, but also potentially other investors or even, those in the community. So that's sort of my 2 cents on that.
Yeah, fantastic. And then following up on that, Betty, who should be your first hire? Since we're talking about fund managers and whatnot, let's talk about all sides of it.
Sure. Well, when I first started at BII, our controller left, and I was in a nightmare situation where I came to value the CFO position. So, I mean, if you can't, like, I am not a finance person, as you can tell. I came from the legal environment, but that is why we have an investment director and we have an impact director. So depending on what kind of fund you are, you need someone that can actually do the investing, right? That is savvy enough, that can take a deal from diligence all the way to structuring and execution. And we had that already. But I think often people don't recognize the back office part, right, of funds, that you also have to manage both the investor side. So investor management is a piece of it, and then the portfolio side. So who is going to do that? Sometimes it's the same person, but typically not. Like, and I think you're a team of 3 at Visible Hands. We're 5, going on 6. And it's mostly investing staff, right? You could outsource some of the finance and accounting and bookkeeping, but that is, I think, really critical if you have a large fund. Like, you cannot do this without bookkeeping, accounting, and investment team staff.
Brilliant.
So I don't want to say it's one hire. You need multiple.
Yeah, and also depends on the stage.
Yes, absolutely. Yeah, it does depend on the stage, especially since the companies do have to grow. You know, what you needed, it could be pyramidal or hierarchical in the beginning stages, but then after, once you're seed A or B, actually, once you get to seed B, you have to really look at your structure and think, huh, we have 7 C-suite people, but 2 researchers. Let's think about this. Should we be rearranging things and whatnot? So, Daniel, I have a question for you. What advice would you give to the next person who's creating their own invisible hands? As in, you know, how do they find the people that they should be looking into, and what should they invest in?
Yeah, so I will touch upon the team building and then also
Yes.
the talent, the investing side. On the team
Hmm.
building, to what Richard and Betty have mentioned, that I think every company is different, but really identifying what you bring to the table and what you're missing. So
Hmm.
for me and my partners, I think there are several areas that we knew we could easily cover. And I remember we were talking to one of our advisors, and we were getting ready to make a first real hire. But before we even made a first real hire, I mean, my partners and I worked a year and a half for free without paying ourselves, building the company, right? And this is
Yeah.
like when you're starting an investment firm, there are 3 sources of capital that I think you need. Number one, you need human capital. Number
Hmm.
two, you need the investment capital. And then 3, you need the operating capital, right? So
Yes.
you have to, there's a process to go out and get all those things. So with us, the first hire that we made on the operating side, I remember we were talking to our one of our advisors who became one of our early investors, and he said, hire a designer. And that just threw me off, right? Because I was like, we're building an investment firm. I want somebody who can actually do the diligence and all of that. He was
Yeah.
like, no, hire a designer. And we took that advice, and that was one of the best decisions we made, because the designer, number one, like my partners, you're raising money. You don't have enough time to be building out decks and all of that. You're like constant
Yeah.
meetings back to back. But our designer was phenomenal at creating decks, building the brand, doing all these designs.
And you have nice marketing.
And and our and our designer built our early stages of the brand. She built everything that really helped give us an image of a larger firm before
Hmm.
we became a bigger firm. The other
Hmm.
thing was that also understanding from the design perspective, how do you engineer certain processes? As a smaller team, you want to ensure that you are, I mean, process is religion, right? The more process you have, the easier it is to actually execute. So, I mean, that designer, and I will highly recommend your first employee, probably think about a designer or someone who can think within that perspective.
Hmm.
Because some of the other things are teachable, like how do you do diligence? Those are things that you can teach. So that on the team building side, that's first thing I'll offer. And then on the talent investing side, I think that's what your question was what
Alluding
was
to.
going towards, is that this goes back to the angel investing, and I also connect that to the institutional investing. That for me, I truly want to understand the entrepreneur psychology
Hmm.
and their ability to execute. And I also really want to see kind of, Richard mentioned track record. It's that with their track record, it doesn't have to be, that they've exited a $1 billion company, but I want to see a history of the things that they've done to prove that they can get things done. So
Yes.
those are things that I'm looking for. And then lastly is, are they obsessive about the problem? If I
Hmm.
can talk to them a couple of hours and just like riff off like whatever is going on within that world that they want to build, that gets me excited.
Brilliant. Yeah. That really touches again on the idea of trust. You know, as an investor, are you trusting in the process because you yourself come from this field? Or are you trusting in the knowledge that is imbued into the founders? Do they exude, you know, all of the traits that, you know, hey, I don't know how to build. I'm not a wood maker, or I don't know how to build shutters, but I know this guy definitely does. and do you trust in that? You also touched a little bit on your earlier answer on scalability. Betty, would you like to talk a little bit about scalability of the team itself?
Sure. I mean, I think the bigger your fund grows, the more staff you're going to need. I totally agree with the whole designer thing because I'm going through that now.
Yeah.
And I'm like, I really wish I had a marketing person. As right now we're mostly investing staff, but we're looking for someone, another investing associate. We're also building a fund of funds. So we're doing a lot of Boston Impact that's going to require different kinds of skill sets. And in an impact fund, you have the added layer of someone that does the impact assessment piece, right? So
Yes.
that is an actual position in our organization. I think as I look, we're going to invest $20 million over the next 5 years, right? What does that look like? It's probably 2 more investment people. And then I think it's also folks that can do the relationship management, because it's not just, the folks that do the investing may not always be the best people to stay with that organization to continue doing the building of it, the technical assistance, business supports. Other people may be needed for that. So we've actually brought on another position that we call our field building technical assistance manager. And their role is twofold: to both support entrepreneurs on what they need to continue growing. It's tapping into resources, and then also building the community of other impact investors in Massachusetts, right? So there are other organizations in our ecosystem that we want to try to influence to shift more dollars into this whole community of entrepreneurs of color that we know don't get the same kind of capital as other, larger businesses or white-owned businesses. So we're also doing advocacy and influencing, and there is slated to be a role for that as well as part of our future work. We think about it a bit differently. I mean, it'd be great to hear about how you're scaling your organization, but because we're a nonprofit, we could do a lot of other things around programming. Another piece we'll grow to is our fund manager cohort. So we're training other emerging fund managers on how to launch similar impact funds. And that's another thing that everyone's excited about. There's a lot of interest in the philanthropic world to do that, but it requires more talent to do that.
It does. Richard, would you be able to speak a little bit about Underscore and how you guys are able to touch upon impact investing as well?
Sure. Yeah. And I'll touch upon kind of how we also thought about building the team too, because it's kind of relevant to the discussion. I would say at the very beginning of whether it's a company, whether it's a fund, I actually think having somebody I would call an athlete is really, really important. It's basically somebody who can do any number of things. And whether that's community building to investing to doing the back office financials. And so for our first 3 years, it was actually just 3 of us. And, when we got a term sheet, we would run it all the way through the final closing process, and then ultimately about 3 years later we hired a CFO, and they could just take off after the term sheet signing and all that. And so I think everything kind of grows and lurches and stages, if you will. And I think the way that we think about impact, and we're actually a little bit different than a traditional venture fund in that while we have 5 partners now, we have 300 people who share in the carry of our venture fund, which is a little bit unique in that we actually presume that we're not the experts, and that the people who are in the community, whether they're at various stages, seed, series A, series B, or different domains, whether it's fintech, whether it's vertical software, or even functional, so marketing or sales, all of these people have a unique expertise in a way that we could never have it on our staff. And so what do we do is we actually offer the opportunity for them to earn economics in a way where they don't have to be accredited, and they can participate in helping us build these companies. And so for us, ultimately, we would hope that we're spreading the pie a little bit more broadly, and basically hopefully trusting in abundance that across the span of time, when some of these companies exit, it'll create the next generation of angel investors, and hopefully then they'll be able to invest into the other next great startups, and through that whole process creating alignment and helping these companies. So that's sort of my 2 cents. Do we lose?
So I think
Vic?
we might have lost her for 1 second, but we do have some questions coming in through the feed. So as we try to get her back up and running,
Yeah, we can
maybe
take some
jump
feed
over
questions.
some feed questions. So Maureen was asking, when investing your own money, what type of terms do you usually using? Are you going after safes? Are you doing convertible notes? What have you? What is your kind of go-to?
I mean, so I'm not usually structuring it. The entrepreneur already is doing around, and when you're that early, it's often a convertible note or a safe, right? So I'm jumping into around, but I invest typically through a group, so Pipeline Angels or Astia. There's other funds, right, like Portfolio, which it's like you could be a fly on the wall and observe the pitches, but there's an investment committee. So there's different ways that you can do angel investing, and the structure of it too. Sometimes it's straight up preferred stock, but I'm not in a position to be the lead and structure the deal myself.
Yeah, I mean, when I first started, I really that's such a good question actually, because when I started, I had no idea about how, the terms. It was just this person is doing something really, really cool, and I have 5,000 here. I'm just gonna invest in that person. But over time, I've gotten an understanding of the terms and how to even have a perspective on if I should negotiate the terms or not. But typically, though, at the early stage, if you're coming in as an angel, you're coming in a round, and they also don't. They're not. It's not a seed round. It's mostly they're raising on save, probably early before pre-seed. So they're also trying to figure out what that value is. So there's really not a predetermined kind of equity financing round. So you are participating in what the founder is presenting, and if you think it's too crazy, then you push back.
Civic, we were just jumping as you were getting back online here. We were just asking the panel if there were any particular terms they usually go after. Are you still there? Can you hear us? Looks like she's still working on that. Well, there's some other questions I can pull from the feed as well. So there was a follow-up to that question where it was asking, I'm going to read it verbatim for what the person wrote. So following up on Maureen's question and looking at the investment environment now, for a convertible note on an early stage company for which you were excited about the business originally and which already has investors via safes or on the cap table, are you looking for a particular interest rate or term length, specifically to convertible notes, if you guys have already done any of those to date?
Yeah, go ahead.
Well, actually, you're the lawyer. You probably have seen a lot.
Well, I'm not a lawyer. I'm a recovering lawyer. They range, right? So the interest rate, I mean, on a convertible note, it's a debt instrument, right? And it converts at some trigger event, usually then a priced financing round. So what you're looking for is an interest rate that could be anywhere from 4% to 7%, right? Right now, although we have shifted more to an investor friendly market, right? It's when entrepreneurs can drive it. Like you want to, as an entrepreneur, you want to push for that lower interest rate. But I think most of my notes are somewhere in the 5-6%. And then there's a discount at conversion that could be 15% would be the lowest I've seen it. Could be as high as 30. And then there's sometimes a valuation cap, right? And I mean, that varies on what we think, right? Yeah, that can fluctuate a lot. But those are the main things you want to look for. And if you're investing in a group, like if you could get, your friends to put in collectively 50K, 100K, something of some magnitude, you could try to negotiate some rights around participation in the business. Like that could mean maybe, you know, they don't have a board yet. Could you be a director? Could you be an observer? Could you help them create a board? Could you get access to financials, right? Because oftentimes these are not, you know, they're very small startups. They're not giving you monthly financials, but you may want to see that. So it depends on what level of interaction you want with the company. And so that could be in a side letter. I've done that as part of angel group investing.
Yeah. Following on what Betty had just mentioned, I also want to encourage a lot of newbie angel and baby investors, as what she has mentioned. Get a group of your friends and see if you all are willing to invest in the same area and the same sector. You are absolutely welcome to join an established fund, but don't be afraid of making your own actually have that kind of financial opportunity. I'm Haitian, and we call it a susu, but many different cultures actually believe in this kind of joint investment opportunity. So I really encourage people to have that chat. It's like when we remind each other we should be breaking down barriers and talk about what we all get paid. We should also talk about what we invest in as well.
So we have about 5 minutes left. I want to see if anyone in the audience here in person has any questions for the panel, whether you're thinking about starting your own firm or you're trying to dive headfirst into the angel side. Not right now. I guess if someone is thinking about it, right, I know there are a few Boston area resources for someone to get kind of educated on what it takes to kind of build their own firm from scratch or further taking a step past this panel. Do you have any resources that come to mind that help someone in that endeavor at all?
And is this building your company?
Not building their company. So someone who wants to dive into the angel investing world, right? Build their own firm. So maybe it might be building your own company in that capacity, right? But their first step into this.
I will take a quick stab at it. One thing that I went into, you know, there's lots of things online, like literally called angel investing. An angel resource center was a huge huge first use of mine. But I'd also actually speak to people, you know, genuinely say like, hey, I know you are in investing. Where did you start? What blogs did you read and whatnot? But also YouTube. It's an amazing resource of people who have started their own funds and are looking to educate everyone else as well. So start big and small, but recognize a lot of the information is already out there. The second piece of information I would say is that some people get approached to invest, others do not. Do not wait to be approached. You may not seem like the ideal investor, but you may actually already be the ideal investor. And sometimes you have to be the one to start that. And one third thing is when I spoke to someone who is kind of an investing mentor of mine abroad, he mentioned whenever you're willing to give up a pot of money, when, you know, of course, you're going to be wowed by the pitch decks. Everyone is. But recognize that your money should be, quote unquote, building a bridge rather than building a jetty or a pier. It should actually be helping the company do something very concrete. So you are going from one land to another land. Not only should you recognize that, but the company that you're investing in should recognize that too. So those are some resources. Basically, the information is out there, but sometimes you need to start it yourself, because not everyone will say, hey, you look like you've got money, you should do it. No, figure it out yourself sometimes, and then tell your friends.
Richard, do you want to add anything and kind of go down the line?
Yeah, absolutely.
Yeah.
So a lot of great points, Vic. And I very much agree with the last point, which is always think about funding to where, not just, you know, funding down a pier. I think it's a very important question to ask. You know, if I was starting, I suppose what I would do is just start doing and making investments. And when you do that, then you'll start to realize either you want to formalize a little bit more and potentially raise outside capital and turn it into a fund, One of the platforms I would really highly encourage people to look at is called AngelList, not only for deal flow. I think they have really interesting deal flow on there, far in excess of what any individual probably could see, but also a community of people who are building syndicates and investing. And it often means you can invest smaller amounts across a broader portfolio, which I think, especially in the beginning, is a really good learning opportunity. Let those, instead of investing $5,000, invest $1,000 in 5 deals and watch and learn across the span of time. I think that will teach you a lot more than anything else would. So yeah, I would just highly encourage AngelList, and then I think mentors, right? Anybody who's started or is gone through that process is very open. So I would say just approach those who have gone before, and pick and learn from what they've done. And nobody has all the answers, but at least they can help point in the right direction, or connect you to somebody who does. So that's my 2 cents.
And yeah, just to build on that. So I had started investing just kind of randomly. I actually didn't know what I was doing. So, so I felt like I needed a structure. I needed some learning structure, which is why I did this program called Pipeline Angels that was focused on helping women to become angel investors. And it's a group learning environment. So it's de-risked in the sense that you're investing together with other people that have diverse skill sets, so you can play off each other, right? So someone in your group is really great at finance, another one knows the market, another one may have a sense of what are the risks. Like, I'm a lawyer, so I can look at the legal terms, right? So it creates this nice synergy to do it together. So I felt like I got a lot of value from being in a group. And there are lots of angel groups in Boston. Another place to learn is Angel Capital Association. They're the largest association for angel investors. They do a lot of education. They do regional and annual conferences. They have a chapter here, right? I think so. There's a lot of folks that want to help and want to build the ecosystem of angel investors. It's not hard to find them. And I would say just try it out with somebody else, right? Or join a group. Sometimes the groups have minimums, right? So if you join an angel group, it might require a minimum investment of, it could be 25,000 a year, right? Plus a fee to join. So just keep that in mind, that you're doing it with a group. If you're so bold and you want to do it by yourself, that's great too. But I find that it helps to have multiple people, because even when you're doing diligence, like, you need other perspectives.
Yeah, I mean, all great resources that you've mentioned, the Angel Capital Network, AngelList, Pipeline Angels, Launchpad, just all really good platforms. Another way that I also think about it is that, who are the entrepreneurs that you're really impressed with? And ask them, who invested in them? Is there an angel that they really enjoy working with? And ask for an introduction to that angel, to that person. And as that angel, how did they learn? So kind of reverse psychology or reverse learning, in addition to these resources. And then what Richard also said, just you have to, in order to really learn, you just have to have skin in the game. So jump in and start investing, but be disciplined, do your diligence, understand the psychology of the founder, but you have to jump in.
Perfect. What a great way to wrap up this panel here. We are just out of time, but if anyone in the room still wants to have conversation with some of the panelists here, if they're going to stick around for a little bit longer, I highly encourage you to continue talking to them.